Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, and now finally, after much anticipation, India has finally entered the JP Morgan International Emerging Markets Bond Index. There was a lot of anticipation going into this, but now it's happened. And now, how is this affecting India, its financial system? How is it likely to impact us in the future? And what are the things that the Indian government is going to have to be careful about? To discuss all of this, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for
Thank
joining
you,
us.
Sharad.
So now, Radhika, the bond inclusion started at the end of June,
Right.
but was that the end of it? Or, I mean, does it play out over a longer process? Is there more to
Yeah.
happen?
Yeah, so it's a staggered process. So,
Mhm.
what is expected is that over the course of 10 months, incrementally every month, the weight of Indian bonds in the JP Morgan Emerging Market Bond Index will increase by 1%. So,
Okay.
it increased by was 1% by the end of on June 28,
When it got
2000.
included.
Yes, when it got included. So, every month the weight will increase by 1%. So, by March 2025, where the Indian government bonds will have a weight of 10%, which is the maximum cap.
Right.
And there are like four more countries which have a weight of 10%. So, India will be the fifth country having a weight of 10%.
Mhm.
There's going to be some reorganization in the composition of this JP Morgan Emerging Market Global Bond Index,
Right.
because some of the countries' weightage in the bond index will reduce and India's will increase. So
Right.
that is how the reorganization plays out. So, for example, countries like Czechoslovakia, Poland, Indonesia, they will see their shares coming down and India's share rising over this span of 10 months, so
Mhm.
that by March 25, the share will be 10%.
And this makes sense, right? I mean,
Yeah.
because an emerging economy like India, a strong one, I mean, the weightage should be more for
Yes.
economies like ours.
Yeah. So that is how it's going to happen over the span of 10 months, given that the size of the market is overall $1.3 trillion. That's the
Right.
size of Indian government bond market, but it did not happen till now. Whereas other countries were part of it, India was not part of the bond index due to a number of factors. The most important one being that there were a lot of restrictions on foreign investment in
Right.
government bonds.
That
Uh,
was our own
our own
restrictions.
restriction,
Yeah.
RBI's restrictions on
Mhm.
how much foreign investors could invest in government bonds, and those restrictions still continue to exist. That was the stumbling block, and then there were some operational issues. But at least on the former, we have made some progress that
Right.
on easing the norms governing foreign investment in government bonds.
And yeah,
So
we'll go into that
yeah,
as
so
well.
that has been kind of a trigger, as well as Russia's exclusion from that index.
Mm.
Those are some of the important points that have led to India's inclusion, in fact, quickened the pace of India's inclusion in the bond index. And now the other indices also, like Bloomberg has announced India's
Right.
inclusion, and that will begin from January 2025.
So it's still a longer process. It's not as if June made the inclusion started
Yeah.
and that's it. It
Yeah.
actually will go
Yeah,
on
it
till
will
at least
play out.
March.
Yeah. So now the
Yeah.
implications will play out over the next couple of months in terms of number of factors, like how much foreign flows will come
Hmm.
in. Some amount of foreign flows have already come in because they have factored in the
The
advantages
inclusion.
of inclusion in government bonds, and over the course of 10 months, more funds will flow into. So then there will be implications on a number of factors that we can discuss.
Right. So actually, that's I wanted to start with in the run up to the inclusion date.
Right.
What was the anticipation like? Could we see that foreign
Yeah.
portfolio investors were starting to put more money into the Indian market?
Absolutely. So if we look at FPI investment in Indian debt,
Hmm.
that was the dates that we need to compare is September 23, because
Right.
towards the end of September 23, precisely 22nd September, JP Morgan announced that they will include a subset of Indian government bonds
Hmm.
in the JP Morgan Emerging Market Index for government bonds. bond. And since then, we are seeing increase in FPI investments, foreign portfolio investments in India's debt. And in most of the months from September to July to June end of 2024, we have seen that in most of the months, leaving aside except for April, we have seen that FPIs have been net buyers. So they have
Right.
been, holding more stock of government bonds in anticipation of inclusion. So because it's expected that bond yields will fall, prices will rise, so they can take advantage of capital
Right.
gains. So in the run up to that, we did see increase in FPI investments overall in Indian debt, and particularly in those bonds which have been now included in the JP Morgan index, which is, as I said, it's a subset of the entire universe of government debt, which is called fully accessible route.
Right.
Because RBI has, for a subset of government securities, they have eased the restriction. There are no restrictions now. So only those securities on which there is no restriction of foreign investment in government debt, and those that have at least 2.5 years of maturity and have an outstanding value of $1 billion. So those are now included in the JP Morgan index, which makes up to around 23 securities, 23 bonds. So if we look at these 23 securities, since September till July, we have seen inflows have been around $10 billion.
10 billion.
Yeah, and if we see the period just prior to the inclusion, just count the 9 months prior to that, just for sake of comparison,
Right.
we see that prior to inclusion, 9 months prior to inclusion, the flows were only $3.5 billion.
Okay, so that tells you what the investment appetite has been
Right.
in Indian bonds. So you say that the RBI has made it easier for foreign funds to invest in
Right.
government securities.
Yes.
So what all has it done, and has that had a significant impact?
Yeah, so typically what happens is that RBI has restrictions on foreign investment in government bonds, and that restriction is in the form of a quantitative limit, which is 6%. It keeps on increasing, but as of now it is 6%, which means that foreign investors cannot invest more than 6% of the outstanding stock of government
I see.
bonds.
So I see. Okay.
So if the stock of government bonds increases up till 6% of the outstanding stock of government bonds, the FPIs can invest. So that was a major stumbling block, and because of this restriction, the movement towards inclusion of Indian bonds in the emerging market bond index was not happening.
Right.
Then during COVID time, around April 2020, RBI announced what is called the fully accessible route, where it said that for some securities we are completely removing any kind of restriction.
Right.
Percentage based quantitative limits, we are removing any kind of this restriction on foreign investment in government bond, and they can invest up till the amount of the outstanding amount.
So theoretically 100%.
Theoretically,
I mean, of course, it won't
100%. It
happen.
won't happen. It hasn't happened even now, but so
Right.
that is the thing. So and that alongside other operational easing has triggered this movement of inclusion of government bonds in the emerging market index. So again, not all bonds are included. It is only these bonds that are part of this fully accessible route. They are around 30 securities, and not all 30 securities are included in the JP Morgan index, because they also have certain condition. Their condition is that that particular security should at least have a maturity of 2.5 years left,
Right.
residual maturity.
Right.
So if we exclude that, and then some norms governing the outstanding value, which should be around $1 billion. So that gives us around 23 securities. Of course, this number will be dynamic over the course of months, depending on the maturity profile. But as of now, when they are included, 23 bonds out of the FAR securities are part of the JP Morgan Emerging Market Bond Index.
Okay, so now that the inclusion has started,
Right.
What does this mean for India, and in particular the government,
Right.
the banks, and our foreign exchange? I'm guessing these are the three broad
Absolutely.
areas that will be affected.
Yeah. So first, starting with banks, if we look at the the ownership profile of government bonds, who holds government bonds, and that data comes out every quarter alongside the quarterly report on public debt management,
Right.
which is released by the Ministry of Finance. What we see is that mostly it is the domestic institutional investors who are holding government bonds, and that is the practice elsewhere also. But here, the proportion of institutional bond holding is largely by captive investors like banks, insurance companies. So they are by law they are mandated to invest a certain proportion of their liabilities. For example, banks, the norm is SLR, statutory liquidity ratio. Banks have to invest a certain proportion of their net demand and time liabilities in government securities.
Right.
So what we see is, we look at the recent data, almost 38% of outstanding bonds are held by commercial banks, then insurance companies, provident funds, and RBI. Taken together, these four investors are accounting for 80% of the overall holding.
I see.
So the holding by FPIs is very small, it's just 2%. And it has increased gradually from 1.3 to 2.4% now, as per the recent data. So if banks are holding a greater proportion of government securities, they cannot free up resources to lend elsewhere, lend
Right.
for to corporates, lend to MSMEs, and so on. And at a time when they are scrambling for deposits, and at a time when credit is rising, we've talked about the rising CD ratio, credit deposit ratio. At this time, if there is some attempt towards freeing up banking lendable resources, banks lendable
Meaning
resources,
that they don't need to put as much into
government
government bonds,
securities,
they
they
can
can lend
put it
elsewhere.
elsewhere.
Yeah, so that is definitely a positive step. And generally, if we move towards a more diversified ownership base, it induces competition, it lowers the cost of borrowing, it helps in development of markets, and so on. So this is the first advantage of this, in principle, is going to be that it's going to lead to a more diversified ownership base, and
Right.
banks will be free to invest in to lend elsewhere. That is number one. The second is on, because now there's greater appetite for government bonds. In principle, it would lower the cost of borrowing
For the government,
for
of
the
course.
government.
Yeah.
And if we look at the data also, if we look at the bond yield, the 10-year bond yields, since the inclusion announcement that was made in September, yeah, till now, we have seen that there has been a decline in the 10-year bond yield, because
So already it's cheaper for
it's
the government to
already
borrow.
cheaper. Yeah, so
Okay.
so the inclusion, the announcement of inclusion has acted as a sentiment booster. So it has led to reduction in the yields, and around yield has fallen by almost 2% during this period. Of course, there are other events which influence 10-year bond yields, like particularly what's happening in the US, whether they are going to raise interest rate or reduce interest rate. That has implication. But overall, if we just compare these two periods, September to June, we are seeing that there has been a declining trend.
Okay.
And that is a good news for corporates also, corporate bonds, because government bonds act as benchmark for corporate bonds.
So it becomes cheaper for them also
for
to
them
borrow.
also to borrow. And there also we see the 10-year corporate bond yields have also come down during this period.
Okay.
So that is the third implication
And
of
it's also good news for, I guess, all of us as well,
yeah,
because I mean, if it's cheaper for the government to borrow, then that means it's using less of our tax money to just pay
absolutely,
interest.
yes,
They can put that money to better use, to more
yes,
productive use, maybe
yes,
more capex,
yes,
maybe more welfare schemes.
yes, yes.
So that helps us.
Yeah, that helps us. So it helps retail investors, it helps
Right.
households in every way. It helps in crowding in rather than crowding out, because it's not that the government bonds are taking away all the investable
Right.
resources. So that is another implication. And then the last one is on the exchange rate.
Right.
Because now it is expected that there will be somewhere around 20 to 25 billion dollars of fund flows coming in because of the inclusion of Indian bonds in the index, because there are some investors who track this index, because this index is tracking the local currency bonds. These are all rupee denominated bonds. bonds. So there are what are called passive investors who track the index, and they only invest in those securities which are part of the index.
Right.
So there's going to be a flush of funds. We already have seen $10 billion have flown by, and RBI and there has been an appreciation pressure, because when there
On
is
the
more
rupee.
dollar, when there is more inflow of dollars chasing rupees, then the value of rupee tends to rise. So there is going to be an appreciation pressure. Now, how RBI reacts to this, that will depend. That will depend on a number of factors, and there are various options that RBI has. One is that it doesn't intervene and allow rupee to appreciate as per market forces, but that is not a very likely possibility.
As we've seen, the
We have
RBI
seen
seems to be intervening quite a
lot, both in the spot as well as in the forwards market.
Right.
So RBI will be absorbing the inflows and trying to keep the rupee dollar rate stable, because what we have seen over the last couple of months, normally what happens is when the dollar appreciates, rupee depreciates.
Right.
But here what is happening is, even when the dollar is appreciating, rupee is also appreciating, and that is more has to do with the amount of dollar inflows that are flowing in anticipation of this inclusion of government bond. So now when there is RBI intervention, RBI will absorb dollars and release domestic liquidity. So there will be going to be more rupee in the economy. There's going to be more domestic liquidity.
That might be also inflationary.
That will also be inflationary, and then RBI will have to tinker with its liquidity management framework. It would have to ask banks to absorb that liquidity either through reverse repo auctions, because with repo, liquidity is infused, with reverse repo, liquidity is absorbed. Either that will be used, or open market operations, or cash reserve ratios, or another possibility is the issuance of market stabilization bonds, which were issued also in early 2000s when there was a flush of funds and there was rupee appreciation. So RBI asked government to issue what are called market stabilization bond, and those who are investing, then they help in absorbing the liquidity,
rupees,
the rupee liquidity. But here, there is a quasi fiscal cost attached to it, because government would have to pay rate of interest on those bonds. So it's not something very, and if it happens on a very persistent basis, the cost is not going to be trivial. It will entail fiscal cost, which has to be shown in the budget. So there are all these implications, and there are a lot of these instrumentalities which will have to be seen and considered over the next couple of months.
And now, apart from that, there are also several other things that the government has to be cautious about, because now that it is playing on the international field, as it were, there'll be a lot more scrutiny from foreign investors, foreign governments even. So what are the kind of metrics that our government is going to have to be careful about now?
So absolutely, there's going to be greater scrutiny of government's fiscal plans, of government's borrowing plan, of government's fiscal deficit, its debt trajectory, debt stock. So we have seen that the government has done better in last year, FY24, in terms of its fiscal deficit coming at 5.6%. The target was 5.9%, so it has done better. And there is this target of achieving 4.5% by FY26. But what now the potential investors would want to see is, what is the glide path going forward. So that is important. Is there more transparency in articulation of that fiscal roadmap going forward? Because even now, if we look at our debt stock, it's quite elevated. The general government debt stock,
it's up 86%.
So it's so as per various estimates, it's above 80% for sure. So 82%, 83% around this time, around this value. So that is something that has to be articulated, that what is the government strategy towards reducing debt, and if there is any deviation that could lead to outflows and could render bond yields more vulnerable. So that is one. And the other is also, if there are geopolitical shocks, that would also make the bond yields vulnerable. That is, of course, if something happens in the US, if there's some shutdown happening there because of their fiscal constraint, that will will happen? All the external shocks, the government bond yields would become prone to whatever is happening externally. We are no longer immune to whatever is happening in external world. So what is more important is to develop resilience in the form of having solid macro fundamentals, and that is to say that have manageable fiscal deficit, have manageable current account deficit, and have a transparent fiscal strategy.
Okay, and now we have an audience question from Abhinav. He says that though it is expected to bring down the interest rates for our bonds, which we've talked about, won't the inclusion of our bonds in global indices also increase the share of our external debt, which he says is currently at 16.7% of our GDP? Because if it draws foreign interest and they buy government bonds, then this will increase, uh, foreign ownership of government debt. So, if yes, then till what levels is external debt considered sustainable?
Yeah, so there are a lot of indicators to assess the sustainability of external debt. But before that, what is useful is to understand the composition of external debt in India. And if we see the composition of external debt, it's mostly non-government. Mostly the external debt is by non-financial corporations and not by the government. So that is number one. Secondly, even when we talk about sovereign external debt, the most important proportion, the large proportion of it is in the form of external assistance rather than external
I
debt.
see.
So around almost 69 to 70% is in the form of external assistance rather than debt. Now we are left with 30% of sovereign external debt, in which some part of this would be this FPI, investment in government bond. Again, the good point is that this is rupee denominated, so it's not the various exchange rate risks, hedging costs,
That doesn't
all
come
those
in.
have to be borne by FPIs, the foreign portfolio investors or foreign investors, rather than by India. So that is another important point. So if we go by the composition, firstly, as I said, that it is mostly non-government.
Right.
Government sovereign external debt is a very small proportion of the overall external debt, and within sovereign external debt also it's mostly in the form of external assistance. Then there is a small category called OGD, other government debt, and within that we have SDR, special drawing rights, we have defense debt, and we have FPI, investment in government securities. So and there also, if we see, there are various currency composition. Dollar is the most prominent thing, but here this is rupee denominated.
Yes.
So the point here is that as of now it is not a cause of concern because it is a very small proportion of the overall debt, and given that only a small subset of the entire universe of government debt market is being included in the bond index
It's
as
unlikely
of
it'll
now.
rise very sharply.
Yeah, it is unlikely that will rise very sharply, and because overall external debt is mostly non-sovereign, and it's mostly dollar denominated, but here this is rupee denominated. So the various stability risks that are associated, default risks, that mainly are associated with dollar denominated rather than rupee denominated.
Right.
But as and when, if there is a case for monitoring and re-looking, then at that time it will be looked, what is the safe proportion. But as of now, our overall external debt is also quite safe. Various metrics, be it external debt, short-term external debt, external debt to forex reserves, and within that universe also sovereign external debt or general government debt is a very small proportion. So as of now, we don't need to worry about this aspect.
Okay, so there you go. The India's inclusion in international bond indices has started, and even when the announcement was made in September, between then and the actual inclusion's beginning, already foreign flows started coming into India, showing that there's enthusiasm for government bonds. This has a lot of ramifications. It will reduce the cost of borrowing for the government, which will reduce the cost of borrowing for corporates. It will free up some of the banks, or likely free up some of the banks from having to invest in government bonds. They can start to lend to other areas that need this credit. But on the flip side, the fact that we've now opened ourselves a little bit to the world means that there'll be greater scrutiny, and there'll be that increase in risks from abroad. So far, we've been insulated, but that insulation is slowly being eroded as we open up ourselves to the world. But overall, it seems to be a good thing for India and the economy. It even benefits us, the normal public. So it's actually a great thing that this is happening, and how it plays out, of course, we'll see over the next year. But on that note, that's all from us. Thank you for watching.